So I'm going to show you how you can make money trading using average volume and average range by weekday. But I'll first explain what they are and how they're relevant. So average volume is important because when there's high volume, moves have nice follow through and they don't fake you out. It's generally not choppy when there's high volume. There's a lot of people buying and selling, the moves move nicely, and it's a very smooth, clean price action. When volume is low, it's generally choppy, you might get faked out, and it just makes it harder to make money. When there's high range is a very important thing because if you want to make $2 a share and something moves $10 on average, you only need to catch a small piece of the move. But if you want to make $2 a share, but something moves $4, you need to catch half of the move. And it's a very important distinction because you need to be much more accurate and you need to be much more precise with your entries and exits when the range is smaller. So here you can see that on Mondays, the day's ranges are much lower, are less than $4. And then on Thursdays and Fridays, it's above $5. So you need to catch such a smaller part of your move on later in the week than you do in the beginning of the week. And as you can see, obviously the higher volume, the higher range, and the lower volume, the lower range. So if you struggle with precise entries and exits, you want to stick to later in the week. And maybe you can just watch earlier in the week because there's more meat on the bone later in the week. There's more opportunity later in the week because you don't need to be as precise. You don't need to be a sniper. You don't need to be exact. And this is how you can use this information in your trading because you know that on Mondays and on Tuesdays, it doesn't have the best trading opportunities because volume is lower and range is lower. So you need to be much more precise. And that's how you can make money trading.